Welcome to Intelligent Investor Insights with Joshua Barone and Robert Barone, your co-hosts and guides through the noise of today's markets. Here, we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place.
It's about time, Josh. I mean, look at what happened this morning, June 2026, the FOMC meeting, and Kevin Warsh just completely blew up the entire playbook, holding the federal funds rate steady at 350 to 375%. Okay, that was expected by the street, but the way they communicated it, absolute demolition of the post-2008 consensus.
Well, I was standing on one foot in the office when the headline hit, Dad, and my first thought was, okay, the old man is going to have a field day with this. Holding at 3.50 to 3.75% is almost a footnote. It's the absolute silence where the usual 5,000 words of central bank justification used to be.
It's beautiful, Josh. For 15 years, we've had these micromanaged, highly sanitized academic dissertations masquerading as policy statements. And Warsh just walks in with a wrecking ball. The Fed model of overpromising and under-delivering is dead. He basically told the market, we aren't your babysitter anymore.
My clients have been conditioned to treat every single Fed press conference like a papal conclave, looking for white smoke in every syllable. And today, they got a bucket of cold water. No hand-holding, just here's the rate, we're keeping it here, now go do your jobs. It's a massive paradigm shift, Dad.
Because forward guidance was always a lie. It was a fiction created to give Wall Street a security blanket. The idea that a committee of 12 people can sit in Washington and predict where the cost of capital should be in 18 months is its peak intellectual arrogance. Warsh did the only honest thing. He killed it. Completely eliminated any forward-looking promises.
But wait, if you completely strip out forward guidance, aren't you just injecting massive raw volatility back into the front end of the curve? I mean, active managers, the guys I talk to, they are losing their minds right now because they can't price their model portfolios without those little breadcrumbs. They're used to the Fed telling them exactly when the next rate cut is coming.
Good. Let them lose their minds. The market should be pricing risk, not pricing the Fed's intentions. For years, the Fed has been the primary source of market distortion. By telling everyone, we're going to keep rates low for 3 years, they created a generation of investors who forgot how to actually underwrite a loan or value a business. Now, you have to look at the actual economy, not the Fed's dot plot. It's a return to sanity, Josh.
It's like taking the training wheels off a kid's bike while they're going down a steep hill in Reno. Sure, it's honest, but there's going to be some skin knees. If the Fed isn't predicting its own path, then the bond market has to do actual work again.
It was exactly 130 words, Josh. I counted 130 words. The last statement under Powell was, 800? Filled with qualifying clauses and on the one hand, on the other hand, nonsense. Warsh's statement was blunt. The key line, the committee will deliver price stability, period. No qualifiers, no subject to incoming labor data, just a cold, hard commitment.
The committee will deliver price stability. That is almost threatening, Dad. It's not we're aiming for it or we're mindful of the dual mandate. It's a direct promise. It reminds me of the way Paul Volcker used to talk. But does a 130-word statement actually give the market enough to go on? Or is it just a strategic power move to show who's boss?
It's both. It's signaling that the Fed is no longer trying to manage public relations. They're managing the currency. When you write a long, complicated statement, you're trying to please everyone, the politicians, the equity markets, the banks. When you write 130 words, you're saying, we have one job and we're going to do it. And if it hurts, too bad. That is how you rebuild credibility that was lost during the transitory inflation debacle of 2021.
Right, but the quote unquote dual mandate still exists on paper. By focusing so heavily on price stability in such a short statement, isn't he effectively demoting the employment side of the scale? My clients in Reno who run businesses, they're looking at labor costs and thinking, if the Fed only cares about inflation, they'll run this economy into a brick wall to get it down.
They might have to, Josh. Look at the summary of economic projections, the SEP. This is where the real story is. 17 out of 18 participants now see upside risks to inflation. 17. That's not a divided committee. That's a consensus of fear. They realize that structural inflation is sticky, and they are terrified of letting it get out of hand again.
17 out of 18. That is a stunning majority. Usually you have at least 3 or 4 doves clinging to the supply chains are normalizing narrative. But this tells me they're seeing something in the underlying data that suggests the old models, the ones that predicted inflation would just magically drift back to 2%, are completely broken.
They are broken, because those models are based on a world that doesn't exist anymore. They're based on the 2010s era of cheap labor, cheap energy, and global peace. That world is gone. The fact that almost the entire committee sees upside risks means they are finally admitting that the natural rate of interest, R star, is higher than they've been willing to admit. They've been playing with fire, and they're finally smelling the smoke. And they explicitly called out the Middle East conflict in the statement, Josh. That is highly unusual for a Fed statement. Normally, they hide behind vague terms like global developments or external headwinds, but Warsh put it right out there. Why? Because they are admitting that monetary policy cannot fix a supply shock. If oil spikes because of geopolitics, the Fed can't pump more oil. They can only crush demand to compensate.
Exactly. They're acknowledging they only have a hammer, even when the problem is a leaky pipe. If the Middle East is causing supply chain disruptions and energy spikes, the old Fed would have tried to cushion the blow by keeping rates stimulative. Warsh is doing the opposite. He's saying, if supply shocks are going to push inflation up, we have to keep rates restrictive to keep inflation expectations from unanchoring. It's a very painful logic for the real economy.
But it's the correct logic, Josh. If you try to stimulate through a supply shock, you end up with 1970s style stagflation. You get the worst of both worlds. The Fed is finally admitting its limitations. They can't create oil, they can't create microchips, they can't create shipping lanes. They can only defend the purchasing power of the dollar. It's a brutal, necessary realism. Now, of course, Warsh is still a bureaucrat at heart, so he couldn't help himself. He announced 5 new task forces to study everything from structural inflation to financial stability. This is classic Washington. When you don't want to make a hard decision, or when you want to look like you're doing something while actually doing nothing, you create a committee.
Come on, Dad, give him a break. The guy's trying to rebuild a century-old institution. If he's going to abandon the old models, he has to replace them with something. 5 task forces, sure, it sounds like bureaucratic bloat, but maybe they're actually trying to find new tools. Underwriting for the apocalypse, as I like to say. requires better data than just looking at lagging CPI prints.
Please, better data. They already have hundreds of PhD economists on staff. They have access to every piece of economic data on the planet. The problem isn't the data, Josh. The problem is the lens they look at it through. These task forces are just a public relations exercise to make the Fed look modern and proactive. It's strategic planning noise while they figure out how to navigate the mess they've created.
Well, one of those task forces is specifically focused on artificial intelligence, machine learning, and using non-traditional real-time data. I mean, my firm is using AI to scan credit markets, Dad. It's not just a buzzword. If the Fed can use real-time credit card transactions, shipping manifests, and alternative data instead of waiting for a revised labor report from 3 months ago, doesn't that help them avoid making policy mistakes?
No, it makes it worse. If you give a group of central bankers high frequency, real time data, they are going to do what they always do: overreact. They will start trying to micromanage the economy day by day, hour by hour. Monetary policy has long and variable lags, Josh. You cannot run an aircraft carrier with a joystick. If you try to react to real-time data with tools that take 6 to 9 months to work through the system, you will create massive artificial economic waves.
That is actually a fair point. If you're steering a massive ship based on every tiny wave that hits the bow, you're going to make the passengers very seasick. But surely knowing what's happening today is better than relying on a payroll report that's going to be revised downward by 80,000 jobs next month. The revisions have been brutal lately.
The revisions are always brutal because their seasonal adjustment models are designed for a stable pre-COVID world. But the solution isn't to look at more high-frequency noise. The solution is to have a stable, predictable policy framework. You don't need AI to know that running a 5% budget deficit at full employment is inflationary. You just need basic common sense economics, something that seems to be in short supply in Washington.
Okay, let's talk about the practical side of this. For my clients, a guidance-less Fed means the Fed put is officially dead and buried. I can't go to a client and say, "Don't worry about this real estate debt. The Fed will bail us out if things get tight." We have to underwrite every single trade as if rates could go to 5% or stay at 3% forever. It changes the entire math of wealth preservation.
It means you actually have to be an advisor, Josh, not just an index fund salesperson. It means you have to buy assets that have real cash flow, not just speculative growth that relies on cheap financing. If you can't explain a trade while standing on one foot, you shouldn't be making it. This new regime forces discipline back into the market.
It does. It means we're looking for a dollar for 50 cents again. We're looking at balance sheets, actual free cash flow yield, debt maturity schedules. If a company has to refinance its debt in the next 18 months and they don't know where the Fed is going to be, they're in trouble. We are avoiding highly leveraged businesses like the plague. It's a return to fundamental credit analysis, which, honestly, has been a dead art for a decade.
It was a dead art because the Fed made it dead. They subsidized bad behavior. Now, the market is finally going to punish companies with weak balance sheets and reward those with cash. That's how capitalism is supposed to work. The Fed put was a moral hazard that poisoned the entire financial system. But my concern, Josh, is that despite Warsh's talk about a new era, they are still fundamentally trapped in the same institutional loop. They are still going to look at the household survey. They are still going to look at the shelter component of CPI, which lags real world rent prices by 12 to 18 months. and they are still going to make the same errors. They'll stay too tight for too long, just like they stayed too easy for too long.
Right, because if you don't have forward guidance, you're essentially driving the car by looking in the rearview mirror. If they see inflation starting to tick down, but they refuse to signal a cut because they don't do, quote, guidance anymore, they might miss the turning point entirely. By the time they actually cut, the credit cycle might have already rolled over, and my clients with commercial real estate exposure will be taking some serious medicine.
And that is the risk of, quote unquote, strategic ambiguity. If you don't tell the market what you're thinking, the market will assume the worst. The bond market will price in higher term premiums, which drives up borrowing costs for everyone, even if the Fed doesn't actually raise rates. It's a dangerous game Warsh is playing. He's trying to look tough, but he might end up breaking the plumbing of the financial system.
So, where does this leave us, Dad? If we are in this new era of higher structural inflation, no forward guidance, and a Fed that's willing to let the market find its own level, what is the long-term playbook? Are we looking at a permanent regime of 3 to 4% interest rates? Or is this just a temporary hawkish stance before the next crisis forces them to capitulate?
It's a permanent regime, Josh. The era of zero interest rates is over. The demographics, the deglobalization, the massive fiscal deficits, they all point to higher structural inflation. Investors who are waiting for rates to go back to 1 or 2% are living in a dream world. You have to adapt to a world where capital actually has a cost and where the central bank isn't going to save you from your own bad decisions.
Well, it's a healthy discipline, even if it's a painful transition. We're telling our clients to focus on resilience over maximum optimization. No more chasing that last basis point of yield by taking on hidden credit risk. We're building cash reserves, buying short duration, high quality debt, and staying incredibly patient. Like I always say, real wealth isn't rushed. It's engineered to last generations.
Exactly. Patience and discipline. It's what I've been preaching for 40 years. Maybe now people will finally start listening.
Don't get your hopes up, Dad. Wall Street has a very short memory, but for now, we'll take the discipline where we can get it. Good chatting with you. Talk soon.
Talk soon, Josh.
Thanks for joining Joshua and Robert on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional level analysis, and a partner in building durable wealth. Reach out to start the conversation with a member of our team, Robert, Joshua, Andrea, Mike, or Eugene, and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational, stay disciplined, and invest with intelligence.